In this episode, we are going to talk about the truth behind the OPEC cut in oil production and why it's a slap in the face to the US President Joe Biden and European countries. On October 4, the Organization of Petroleum Exporting Countries, OPEC, and its alliance, known as OPEC Plus, slashed oil production output by 2 million barrels per day, boosting crude oil futures. As per report, on the next day, the November crude oil futures on VTI, which is the West Texas Intermediate, were at $87.89, up by 0.15%, while December Brent oil futures were at $93.49, up by 0.13%. The move represents a major reversal in production policy for the alliance, which slashed output by a record 10 million barrels per day in early 2020 when demand was lower due to the COVID-19 pandemic. The oil cartel has since gradually reduced these record cuts, even if several OPEC Plus countries are struggling to fulfill their share. While Saudi Arabia, one of the founding members of OPEC, claimed that the output cut, equal to 2% of global supply, was caused by the weakening global economy and interest rates hikes in some Western countries, the US and its NATO alliance have accused the group of colluding with Russia. Here is what to know about the OPEC Plus decision and what it could mean for the economy and the oil price cap. OPEC Plus is a group of 23 oil exporting countries which meet regularly to decide how much crude oil to sell on the world market. At the core of this group are the 13 members of OPEC, the Organization of Oil Exporting Countries, which are mainly Middle Eastern and African countries. OPEC was founded in 1960 as a cartel with the aim of fixing the worldwide supply of oil and its price. Today, OPEC nations produce around 30% of the world's crude oil. Saudi Arabia is the biggest single oil producer within OPEC, producing more than 10 million barrels a day. In 2016, OPEC Plus was created with OPEC members nations allying with 10 other oil-producing countries like Russia, Azerbaijan, Bahrain, Brunei, Kazakhstan, Malaysia, Mexico, Oman, South Sudan, and Sudan, inflating the group's strength to 23. While the OPEC status states that any country with a substantial net export of crude petroleum, which has fundamentally similar interests to those of member countries, may be admitted under special conditions, the formation of the OPEC Plus group was seen as a response to protect their interests amid the rise of the US shale industry. OPEC countries effectively control more than 79% of the world's crude supplies, regulating oil prices as per their interest. And now the question, why slash oil production? At its first face-to-face meeting in Vienna since March 2020, OPEC Plus members agreed to cut production from August 2022 levels by 2 million barrels per day to less than 42 million barrels. The cut, which will take effect from November, represents around 2% of the global oil supply and is larger than expected. The move is designed to boost the cost of oil, which has fallen below $90 from a peak of $122 in June. Prices rose after the announcement. The higher oil prices could increase inflation and cost of living for countries buying the oil using US dollar. The United States, which is scheduled to go to midterm polls in November, will be hit pretty hard by this production cut, leading to soaring inflation. The US had increased its interest rates and imposed three-phase sanctions on Russian oil to limit Moscow funds to stop war in Ukraine. The first set of sanctions will target Russian crude oil, while the second one will focus on diesel, and the third will tackle lower-value producers such as naphtha. Facing global condemnation for its invasion of Ukraine and heavy economic sanctions, Russia has already indefinitely closed Nord Stream 1, an underwater gas pipeline, after leaks were noticed in the Baltic Sea. This pipeline supplied European states with 25% of their total Russian gas imports. Russia, which supplies European Union countries with 40% of their natural gas, has been steadily reducing its supplies since the EU imposed heavy economic sanctions on Moscow. While the EU has claimed the pipeline was sabotaged, Russia has denied responsibility. With oil prices soaring in European nations and the US and rising inflation, the OPEC plus oil production cut helps Russia to attack NATO. The oil production slash came months after the US President Joe Biden's visit to Saudi Arabia in a bid to dissuade the bloc from lowering oil output. However, despite the White House diplomatic effort, Saudi Arabia has not condemned Russia's war on Ukraine and has now aimed Moscow in inflating oil prices, leading to a rise in consumer price in the US. The US President Joe Biden, who has steadily been losing popularity ahead of the midterm polls in November, has time and again been targeted by the Republican Party for his failure to curb gas and food price in the US, struggling to maintain control of the US Congress in the upcoming polls. US President has promised consequences for Saudi Arabia in retaliation to boost oil prices. To curb oil prices, the US is considering releasing its own shale oil reserves. The Biden administration has stated that it will be reassessing ties with the kingdom and have further sought post Saudi Arabia's refusal to condemn Russia and provide any energy commitment to the US. With all this turbulence, what's happening with Russian oil? After Russia invaded Ukraine, many countries bought less Russian oil and its price started to fall. At one point, Russian crude was more than $30 a barrel cheaper than Brent crude oil. By the end of September, it was around $20 a barrel cheaper. India and China, who did not join the Western sanctions against Russia, now account for over half of the country's seaborne oil exports. Russia is now China's biggest supplier of oil, taking over the Saudi Arabia. In March this year, China and India imported more oil from Russia than the 27 EU member states. The EU plans to impose an embargo on Russian crude oil from December 5th. It will be applied to crude shipped by tanker and must pipe supplies. How is the West targeting Russian oil? The US and Britain imposed bans that were mostly symbolic because neither country imported much Russian oil. The White House held off pressing the European Union for an import ban because EU countries got a quarter of their oil from Russia. In the end, the 27 nations bloc decided to cut off Russian oil from December 5th while keeping a small amount of pipeline supplies that some Eastern European countries rely on. Beyond that, the US and other group of 7 major democracies are working out the details on a price cap on Russian oil. It will target insurers and other service providers that facilitates oil shipment from Russia to other countries. The EU approved a measure along those lines this week. Many of those providers are based in Europe and will be banned from dealing with Russian oil if the price is above the cap. The idea behind the price cap is to keep Russian oil flowing to the global market just at lower prices. Russia, however, has threatened to stop deliveries to a country or companies that observe the cap. That could take more Russian oil off the market and push prices higher and obviously push cost of the pump higher. US gasoline prices that soared to record high of $5.02 a gallon in mid-June had been falling recently, but they have been on the rise again, causing political problems for President Joe Biden a month before midterm election. Over the past week, the nation's average price for a gallon rose 9% to $3.87. That's 65 cents more than Americans were paying a year ago. Will the OPEC production cut make inflation worse? Likely yes. Brent crude should reach $100 per barrel by December, says George Leon, Senior Vice President at Rystad Energy. That is up from an earlier prediction of $89. Part of the 2 million barrels per day cut is only on paper, as some OPEC Plus countries aren't able to produce their shares, so the group can deliver only about 1.2 million barrels a day in actual cuts. That's still going to have a significant effect on price. Higher oil prices will inevitably add to the inflation that global central banks are fighting, and higher oil prices will factor into the calculation of further increasing interest rates to cool down the economy. That will increase the energy crisis in Europe, together with Russian cutbacks of natural gas supplies used for heating, electricity in factories, and will send gasoline prices up worldwide. As that fuel inflation, people have less money to spend on other things like food and rent. Other factors also could affect oil prices, including the depth of any possible recession in the US or Europe and the duration of China's COVID-19 restrictions, which have reduced demand for fuel. Wall Street analysts say the Biden administration could counter OPEC's move by releasing stocks from the US Strategic Petroleum Reserve and even boosting the so-called NOPEC bill that will penalize other oil-producing states by opening them up to antitrust suit. Thank you so much for watching. As always, if you find this content helpful, smash that like and subscribe button, turn on the notification bell to be notified every time I post a new video, and see you in the next video. Stay safe.